Hello everyone, thank you so much for joining. Let's get started. I think most people have joined. Just before I start, there's a couple of things. If you've got a question, please type it in your Q&A box, not in your chat box. I know we used chat the week before last. I was on vacation last week, the week before that. But if you could do it in the Q&A box, that would be really, really handy. But delighted that you could all join. Thank you so much, as ever. Let's get going. Do you know what? It's such an interesting week for FX. It really is. And I say that because not just the usual suspects, but there's some really interesting things going on in this market, and it makes it a great market to trade right now. I'm not going to start with cable. I'm going to start with euro. And I'm going to start from a very long-term time frame. That looks a bit silly, that chart. Sorry about that. Let's take a look at the weekly chart here. As you can see, it goes all the way back to 2008. Looking at it from 2008, we look quite weak in our range. Now, obviously, this isn't the one to trade from, but I'm just trying to give you a bit of perspective on what euro-dollar is doing now. It looks very weak within the longer-term range. Consolidating a little, for sure. There's some key levels here. Obviously, this kind of 132 level seems to be like a massive double top in the very near term. Let's go down a notch. Let's go back to daily. As you can see here, this is, yet again, quite weak, but we are consolidating. So this is, what we're seeing is good support, for sure, coming at 128.80, which is this 200-day moving average. But yet again, around about this 132 mark, like we saw with the weekly chart, we've got this double top here, which is proving to be formidable resistance. So do watch out for that there. Do watch out for that level there as well. And the other thing that we would point out too, certainly on the daily chart right now, is that we have got a bit of a bearish divergence here with the MACD. So whereas you've got the daily chart is still going higher, let me just draw that in. I'm just going to have to change my... Right, so whereas the price action seems to be moving higher, we've still got this bearish... we've still got kind of a bearish signal coming from the MACD, so they're both telling us totally separate things. Certainly in the very short term anyway, we've got this, even though they're both moving down, both moving in the same direction in the longer term, right now we've got kind of a bit of a clawback in euro-dollar, but we're not seeing it in MACD. That's the first thing that makes me a little bit suspect about this rally that we've seen. So today we got above 130 at one stage. Let's go back to the hourly chart to really show you that. As you can see here, got above 130. Obviously kind of 130.70 was the high from last week. That's kind of the level to beat right now. But I have a feeling that people are going to be very willing to sell into any periods of strength in euro-dollar. So, a break maybe towards 130.50. I think 130.50 going to be a huge resistance level in the short term right now, largely because we're seeing we're seeing some just a few warning signals within this rally. So, we've seen we did have some data out which I can't actually see because you're on my desktop right now, but we have had data out today. We had the ZEW, we also had inflation data. Added to that, we've also got obviously the big thing really is that EU summit Thursday and Friday of this week. Then what we also have are regional Spanish elections. So it seems to me from a macro perspective we've got a couple of things that are moving the market. There's the Spain aid request, this expectation that Spain will request aid potentially as early as this week. At that EU summit, we had some M&A, which was positive for the markets yesterday. Now we also had a good US retail sales report. So all of that fairly sentiment positive in the market for sure. And what we've seen is, the euro certainly be one of the beneficiaries to that. However, I think from a macro and a technical perspective, I'm starting to see a few cracks. From a macro perspective, the main cracks that I'm seeing is that Spain may not request aid this week. They certainly may not do that because, they may feel certainly Spain has been dragging its feet doing this. It's getting a lot of pressure now from big bond funds, but also from other governments. From people questioning just how how people can trust what the Fed is saying, what the ECB is saying, if they don't, for example, if they don't have if they don't trigger the OMT program. So that's one thing. The other thing, and that's the macro perspective. The technical perspective, as you can see here, this mini rally up here that we've seen just the last few days hasn't really been followed by the MACD, which I believe is significant, and that's a key thing to watch. So what I would say is we could certainly see buying interest, as I said, that 130.50 mark. Also looking up here. 130.80, and then of course that double top, which is not there. Let me just change my pointer again. Makes it much more accurate. Sorry, everyone. I believe there's going to be a lot of selling interest around this 131.70, the 130.50 to 70 mark, and then if we do get above there, I just don't see us extending that rally from the highs from middle of September. I really, really don't. So, whereas it may not be the best place to sell right now, there could be a bit more upside to come, I think the selling will arrive, and that's why I think kind of certainly on any strength on these big resistance levels, I'm going to get a bit nervous. I would potentially be putting in some selling orders, certainly around that 130.50 to 70 mark to start with. If we get above there, I'd certainly be looking at that very, very closely, and if we do get above there, I just don't see us getting above 131.80. So that's kind of a key thing to watch out for. Oh, I've just had a few questions through. Let me ask. Someone's just said, what causes the MACD to track in a different direction to price action? Well, that's very interesting. And really, the way that you think about that is that MACD really is all about momentum. So when momentum isn't on the side of price action, it suggests that, well, maybe that bullish trend is slowing down, or maybe that bullish trend isn't really there. So it doesn't follow price action always fully. As I said, it's a momentum indicator, and it is only one indicator. It's not always... It's actually considered a bit of a lagging indicator, so it's the moving average convergence divergence. So again, it's like an average of price, really. So when the price, so even though we were actually seeing the kind of the spot price here on euro-dollar move higher, the fact that the MACD hasn't joined in on that is telling us that maybe momentum isn't there. Maybe there's not that much buying interest. Now that would feed into some of the things that we're just generally hearing. There doesn't seem to be a lot of conviction in this rally to me. It doesn't mean people are willing to sell it right now, as I said. What it means instead, I think, is that people are going to wait and they're going to pounce around these big resistance levels, and there's two coming up, as I just mentioned. So hopefully, and that's answered your question, Peter, but good one. Someone else has mentioned about different patterns. Cup and handle pattern for sure. You could certainly argue that. Again, some people may, I think I like, certainly when it comes to patterns, I like to keep it simple, and to me, I'm just looking at support and resistance at these levels. I could imagine us range trading really into year end. That is that to me is kind of the key thing certainly to be watching out for. Okay, the other thing to point out, just bear with me one moment, folks. The other thing that is really, really interesting right now is dollar yen. So I'm going to show you dollar yen. Just bear with me one moment. I'm just going to bring up a different chart. So I'm just hoping now you can see dollar yen, this chart here. If FX admin can just remind me, I'm pretty certain you can because I am sharing this desktop. Just drop me a quick, if FX admin could just drop me a quick line just to see that they're seeing this dollar yen chart. But anyway, I'm going to start. Really, really significant and interesting Really significant and very interesting price going on here. Dollar yen is this is an Ichimoku cloud chart. I'm using my Bloomberg terminal for this. Ichimoku cloud and dollar yen work really well together. Some people think so. Some people think that because Ichimoku is a Japanese way of looking at, or a Japanese devised indicator, really, or like chart pattern. Basically, whatever's inside the cloud, you're not trading. If you're below it, you're in a downtrend. If you're above it, you're in an uptrend. Really nice and simple, and that's how I like to kind of keep my technical analysis with FX. Nice, simple, and clear, and that is why I love daily Ichimoku clouds. Those for me are kind of really important, especially if you like breakout trading. And I know that there's some of you here today who do love to trade breakouts. Well, this could be a great opportunity for you. Let's take a look at this. Look at where dollar yen is trading. 78.88. Take a look at the top of this cloud here. That comes in 78.90. When we get above the top of the Ichimoku cloud, that is a technical uptrend. But what makes this even more important, just look at this. We haven't been above the cloud since April. This is significant, folks. This is really worth watching. If we get a daily close tonight around 70, maybe 78.90 to above 79 to even 79, we could end up or we may end up heading certainly towards 80. I've heard some people even looking for a return to these March highs of 85. Now, what does this mean? Dollar yen is a very important cross. Not only is it important just for trading dollar yen, but it can be important for overall risk sentiment, because we know that the yen is such a sensitive risk currency. Dollar yen basically above the cloud and in technical uptrend really suggests that overall sentiment in the markets may be calming, which really kind of combines or really follows my range trade theory or my view that the euro could potentially range trade into the end of the year. Now, some of you I know won't like. I know some of you don't like range trading. However, dollar yen, when euro dollar is range trading, dollar yen could potentially be in an uptrend. So here what we've got, again, as I said, great opportunity. Getting this, this doesn't happen often, guys. That's why I'm saying it. 78.90 is the level to watch. Breaking above this, life above the cloud for dollar yen just hasn't happened for pretty much all of this year. So that is an important one, certainly to watch out for. Remember, even going back to February, the minute we break above that cloud in a significant way, we really shot higher. Now, that was on the back of stimulus coming out of the Bank of Japan. What could happen this time? Bank of Japan probably aren't going to be likely to do as much stimulus as they had in the past, or they did back in February. So what could be the catalyst or the fundamental catalyst? We know that there's a technical catalyst. You can see it in front of you. What could be the fundamental catalyst for dollar yen moving higher or going into a prolonged uptrend? Well, I think that could actually be QE3. And the reason why is that the Fed has pledged to do QE3. It's pledged to, do it unlimited. If we continue to get really good economic data out of the US, they won't need to do QE3. And that's what I think is going to be the key thing, is that there is an awful lot of QE expectation priced into dollar yen already. You can pretty much see it all through the summer, falling below the cloud, moving downwards from July, August into September. And basically, since post that QE announcement, from the Federal Reserve, we've actually moved higher in dollar yen as the overall market reaction has calmed, as we've had that OMT program from the ECB, but also as we've seen some people get a bit concerned about, the fact, or actually just question how much stimulus the Fed will actually have to do. That's a key thing to watch out for there as well. So where would stops normally go? Peter's asked again. Great question. Would they then go at the bottom of the cloud? Well, it all depends on how much of your capital, how big your account is, how much you want to risk. Remember, we would kind of certainly aim for kind of at least like generally a 3-to-1 reward ratio. So, you know, for example, if you have a 50 pip stop, you'd be looking for a 150 pip gain. So really, it doesn't necessarily have to go at the bottom of the cloud, not always, but it's not a bad route to go on. So where are we now? We're at 78.90 now, or that's the top of the cloud if you were to enter. 78.50 is the bottom of the cloud. Now that is quite a tight stop. I'd probably, I mean, depending on how long you think, how wide your time frame is, how long you think this could keep going. If you only wanted I would probably put my stop probably more around the 78, probably maybe around the 78.20 level if you were on a quite short time frame, which is this Keegan line on the cloud, and then so that's roughly maybe 60 pips from where I am now, and I'd probably look for maybe a 200 pip gain. That would be the kind of level I'm looking at. Someone's just said there is also a longer term trend line for possible support. Yeah, I mean that's certainly true. You could certainly let me just try and annotate that. You know, you can always go down here, which again kind of corresponds with that bottom of the daily cloud. So you could, so that kind of 78.20 level. I'd probably go a bit wider than the cloud, than the bottom of the cloud, purely because you never know, something might happen. There might be something out of Spain that could cause a bit of a dip lower. You don't want to be caught out by the market going lower, but then actually spiking back up once the ECB steps in or something like that. So always, you know, give yourself a bit of wiggle room. But I like the 3-to-1 ratio. That to me is the key thing. So I'm glad that helps you guys. The other, I'm going to, you know, obviously, you know, euro, dollar, and dollar yen, they're quite important. Now, there is something else I just want to look at as well. Let me just go on to Aussie. I'm going to still use my Bloomberg chart, don't mind. Aussie dollar, as you can see, let's just zoom in there. Aussie dollar's been kind of interesting. You know, it's bounced off this 101.50 support level at the beginning or last week. It's moved nice and higher in the same, kind of followed euro dollar higher. Run into a bit of congestion here though, and is moving sideways. So there's a couple of interesting points to make about this. Number one, 103 is going to be really stiff resistance for this cross. We've seen it get as high as 10. We've seen it get as high as 102.80 today. But since then, we've kind of backed away from that 103 level. Very, very key resistance level, we would say. The other thing to point out, though, is that there's a good chance that there is a good chance actually that or as you can see here, basically, Aussie dollar has not been following the euro dollar, has actually underperformed euro dollar. And the thing to point out about that is that in the past, what we've seen is Aussie dollar tend to do really well when the dollar falls and outperform euro. So what we've seen is, you know, and that has been, you know, a really important indicator of when risk is on, for example. You know, we've managed to see that do incredibly well. However, then what we've seen since then, or what we've seen in recent weeks anyway, or certainly in recent days as well, is that the Aussie hasn't done that. It hasn't followed suit. The Aussie has underperformed the euro, which suggests that maybe this dollar move, this dollar uptrend, isn't necessarily a sign of risk being on. Now that's going to be important because that maybe suggests that euro dollar isn't necessarily going to sustain its gains. That we may not be in a prolonged uptrend for euro dollar. Now, obviously, the fact that we may have you know, dollar yen and potentially breaking into an uptrend, if that strengthens a lot, that could also limit that because of the way that currencies work. Dollar strength could then feed into some euro dollar weakness, so that's certainly worth watching too. Let's take a quick look as well at euro yen. Solomon's asking to look at. Sorry, euro yen. In fact, look at it from an Ichimoku base. and euro yen has been above the cloud for some time because we actually saw a real nice strong recovery, basically from when Draghi first mentioned the fact that the ECB would do whatever it takes to look after euro dollar. So that's been, to protect the euro. So that's been quite important. This is looking nice. I'm a bit concerned here though. Certainly on a day chart, that looks a bit like a triangle consolidation pattern. If we get above the top of here, this 102.50 level, and we manage to stay above there, then I don't see why we wouldn't necessarily test 105, as long as things in Spain go well. Now remember, there is going to be, people are going to be a little bit concerned going into this EU summit. For example, they may not fully be willing to push us towards kind of 102.50, maybe even towards 103 in the near term in euro yen. You remember euro yen is also your ultimate risk trade from a euro perspective, because the Swiss franc, which is normally your euro risk trade, of course that's still being very much being treated as a or that's still under the SNB's control, so they're still controlling that one. The other thing that I think is worth kind of pointing out for is that euro is as well, as I said, people may wait until after this EU summit, after the Spanish elections, before putting on extra long or putting on more long euro risk. That would be the key thing. Added to that, there could be just a little bit of selling pressure if we start to see euro dollar sell off. So do watch out for that. Personally, right now, I think there's more of an opportunity in dollar yen because of where we are in that with that daily Ichimoku cloud. Euro yen has had its moment, if you like, and we're now looking at dollar yen. The other thing I want to show you as well is cable. Cable's been quite interesting. It's got quite a lot. It's got an awful lot going on with it at the moment, including, of course, we've had CPI this morning, which came in line with expectations. It did fall, but cable hasn't really had... Oh, sorry, that's sterling yen, my fault. Let's go back to cable. It hasn't... We've done fairly well in cable. Didn't have too much of a reaction really to the CPI data, but it has backed away from that 161 level. The other thing the other thing with cable is that we've got a lot of macro data out tomorrow as well. We've got BOE minutes. We've also got labour market data tomorrow at 9:30. So all of that could have an impact. Remember, if we get a negative or a weak reading, then what we could see is euro dollar. Is cable actually starting to react very negatively to weakness, to economic data weakness. Now, we've seen in the past cable react very well to positive data surprises. What happens if there's some negative data surprises? Then we'd expect it to fall off quite sharply, maybe meander back to that 160 level. If we start to see the labour market turn, now some people have said that the UK is in a recession. How can the employment data be so strong? Does that mean that we've got very low productivity, or is it just kind of lagging? Will the unemployment rate actually start to tick up? Will the labour market start to deteriorate into the end of the year? This month, tomorrow's data is going to be really important to really give us a grip on whether or not that's going to happen. So in that sense, 160 I see as being a key level. In the very short term, I think 161.50. 30 to 50 is going to be really, really important. That's the kind of a key support, key resistance level. It will support on the way down, as you can see here. And then going above there, obviously 162. Any kind of big number, any kind of big numbers, we're going to be quite. It's going to be quite. There's going to be stickiness around there for sure. And then what we saw before, on this 163 level, really mythical level, it's a year, it's a 12-month high. We didn't manage to get above it before. In fact, we flatly rejected it. 162.65 was a very important level there. So that certainly is worth watching. And certainly on the downside, from where we are now, around about that 160.75 level, then you'd probably be looking at 160 as good support. 159.75 as well. This this 50-day moving average, also worth watching out for. Now, just bear with me one moment. I just want to show you cable just on this chart, because sometimes you can see things a bit better. But yeah, you know, as you can see, you know, still a way off from that 163 level. In its medium term, it does look like it's still quite weak in its range, but it does look like it's turned a corner, and there seems to be a nice triple bottom there, just below 160. So that 158.50 level should act as massive support if we do turn lower, and that certainly is worth watching out for. Now, that's kind of what I was going over. Now, if someone has any questions or they'd like me to go over one or two currency pairs, then please do let me know. And while you write me a quick note, I'm just going to show you gold, because yesterday, for those of you who follow my notes, you know, gold fell off very sharply yesterday, and the main reason why we believe is because, number one, Spain hasn't applied for a bailout. Number two, data in the US is getting better, which means that these stimulus programs from central banks that people were so worried about causing inflation may not actually even get off the ground and may not be that strong. Second to that, we also saw inflation pressures in China and now also the UK really start to moderate. And when that happens, you don't need an inflation hedge like gold. And that is important. And that's why gold has come off. We're currently around about that 16. So we've fallen again post that UK data there, and the next main level of support is really around this 1650, so really 1680 to 1700 level. That should be really key support, so do watch out for that. It may attract some buying interest. Right now, if we get a pullback towards that 1750 level, then we could actually see it fall again. Then we could see it fall again, so we may see some more we may see some more declines there. So certainly worth watching out for. So I'm happy to take a question if there is one. Oh, someone's given me a question in the chat box. If you could do it in the Q&A box, that would be great. But anyway, I'll answer it for now, but just remember it for next time, please. Would you favour selling opportunities of gold and silver in the short term? I actually would, because I still think, I think inflation pressures still aren't building in global economies. Secondly, I think that the concern that central banks were going to be pumping stimulus left, right and centre might have been a bit premature. And actually any move towards 1750, even 1760 could be sold into. Okay, that's about it from me, guys. It's 10:30. Thank you all so much for joining. It's great to have so many of you join, and for you all to be so into asking questions, and you ask great questions. We might do a few polls next week, see what you guys are thinking, get it a bit more interactive. But right now, I think thank you very much for joining. Good luck trading this week, and please do join us next week for another Trading Tuesday. Thank you.